Hello and welcome to another episode of Good Investing. I'm Rachel Grunn.
And I'm Andrea Swick.
Thanks for coming back. We have a very info-packed episode today.
Yes, and happy 20th guest to us.
Oh my gosh.
Did you know?
No, I didn't even figure that.
Yeah.
20 guests and almost 50 episodes.
Yeah.
That is super impressive.
We've been working hard.
Working hard. And our 1-year anniversary is in May, which is going to be here before we even know it. I can't believe it's been almost a year of Good Investing podcast. Now, Good Investing as a company, been around for, I guess, a little over a year now. But the podcast Annie is in May. Oh, so exciting.
Very exciting.
So we get questions all the time about the 1031 exchange process. And I am so glad that we had this guy on today, Jason Gorman. He's a qualified intermediary for a 1031 exchange. If you have no idea what I said, listen to the episode. But I learned so much that I did not know about the 1031 exchange process.
I got so much smarter.
Yes.
Just by, listening to him. And I asked all of the dumb questions because I'm like, maybe other people aren't familiar with 1031, right? So I'm looking out for our listeners. I asked the basic questions, asked them to break it down, and now I feel so much smarter. I think y'all will too.
Yeah, I'm really excited about it. So let me introduce Jason to you guys. So Jason Gorman is the founder and co-owner of 1031 Texas, as well as partner in Compierre and Gorman PLLC. I don't even know if I pronounced that correctly, so apologies.
Sounds good.
After graduating from the Ohio State University, Jason worked in commercial development in the Washington, D.C. area before returning to Ohio to launch a construction and development company, and soon after, a full-service real estate brokerage, all before deciding to eventually pursue his law degree. After law school, Jason and his wife, who is a native Texan, relocated their family to Austin, Texas, where he met Brad Compierre and formed the law firm Compierre and Gorman PLLC, and later 1031 Texas LLC, a 1031 qualified intermediary. Both the law firms and the QI are dedicated to serving commercial real estate investors by providing sound legal counsel and 1031 services. What do you think about that?
Excited to hear more.
Yes, so you guys tune in for an exciting conversation with Jason Gorman. Hi, Jason. Thank you so much for joining us on the Good Investing podcast. We're so happy that you're here.
Thank you for having me. I've been looking forward to this.
Yes,
awesome.
So have we. So we want to know where you are, where you came from, and how you got to what you're doing now.
Oh, that could be a long story because I've got a rather winding career path, but currently I am in Austin, Texas, not far from you all, I believe. And that happened after marrying a Texan years ago. So, you're always drawn to Texas if you're involved with a Texan. But I'm originally from Ohio, and I've had a long career in real estate, everything from development to broker to for myself. And then I also had a few years in Washington, D.C. working for a large developer out there. Eventually went on to law school. Came out of law school, worked for a title company, Fidelity National Title, one of the big ones. Did a short stint there before coming down to Texas and going into private practice. So I am a practicing real estate transactional attorney, board certified in commercial real estate in Texas. And then our law firm, Compierre and Gorman, has branched out into the 1031 business, and we have a subsidiary that is 1031 Texas, which I am the president of and kind of run the operational side of that as well.
Amazing. Okay, so let's break down for our listeners, what is a 1031 exchange?
A 1031 exchange at its very core is a tax filing. It is, as you ladies know, when you own a property and you sell it, you have to tell the IRS that you've sold your asset. And they will, depending what form you write that down on, will determine whether or not you have gain and taxation and depreciation recapture. But there is an alternate that says, yes, I sold it, But I bought a replacement property, and therefore I'm going to file this on a different form. I believe the form number 8824 with the IRS. But what it is called, a 1031 transaction, is based off the Internal Revenue Code Section 1031. So that's where the name comes from. It is the concept that allows you to tell the IRS, I owned an investment property, I traded it maybe indirectly by selling and purchasing another, but I ended up with a replacement property. And if the values work out properly, where I did equal or greater value, I can do that transaction, report it to the IRS, and defer the taxable gain that would have come from that sale, essentially allowing me to take what would have been tax dollars that I would have need to probably hold back out of my deal to pay my taxes. I can reinvest them fully and end up with the same value of property, or ideally leverage up and expand my portfolio using my tax dollars to reinvest.
And you can't do this on your personal residence, right? It's only the other assets, the other real estate assets that you have.
That is correct. The impetus of this law is that it is the sale of property that has been held for business or for investment. So in our world, investment properties, everybody thinks rental income of some kind, but they're also business assets too. If you are a business that depends on your property and you want to move your business operation, you can actually do it with the sale of business property as well. But from the context of this conversation, probably more applicable to investment property. Personal residence does not qualify. And if you think about that logically, your personal house, you're not doing accounting of income and expenses on your houses like you do with investment properties. It's just something that you own. And also personal residence, there's actually a true tax exemption when you sell a personal residence. So that's in some ways a better deal because that's an exemption, whereas a 1031 is a deferment. Everything is carried forward into the new property.
And what are the benefits and negatives of doing a 1031?
The benefit is not paying the taxes now and reinvesting that money. There's lots of ways to sort of contextualize that. Is people say it's like an interest-free loan from the government. The money that you would have paid them, you get to keep and reinvest. So if that investment earns you exponentially more, or you leverage it up, it can greatly expand your buying power to expand your portfolio. So that's the obvious benefit is that you're putting that money in, you're continuing. The negatives of it are more just that it has rules. It has timelines. There's sometimes you can't make your deal fit within the constraints of a 1031. And the way that I look at that is it's not so much a negative of the 1031. It's just the reality that not every deal fits. Sometimes there's other things besides just I want to sell and reinvest. There's I want to take money out. There's just other concerns. So it doesn't always work, and that's that's okay. That's what I'm here for. I take a lot of calls and questions from people just to answer that question: does this work for me?
So just to clarify, when you do a 1031, you have to be all in. So you have to take whatever cash was from that investment property and put it all into a like kind. You can't take some money out and some money put it into the new investment. Is that right?
That is, yes and no. And the yes is if you want full deferment, if you want no taxation at all, then the answer to that question is yes. In order to get full deferment or no taxation, I have to take all the money and move it over. And really the better way to say that is I have to get a asset value of equal or greater value. So don't forget about debt in there too. It's not just the cash. So if you have $1 million property, say with no debts, you're going to sell and you're going to get minus expenses, $1 million. Well, then you would need to reinvest the full $1 million. If you have that same property where it's $500,000 in debt, and then you're going to get $500 in cash, but you're also technically you got $1 million in debt cash, but you paid off, some of it went to the bank. Only $500 was available for the exchange. A lot of people want to focus just on that $500 in cash. So But what you need to focus on is I sold $1 million property. So over here, I need to buy $1 million property. I have 500,000 in cash. So I have to go get another loan to effectively recreate what I had with what I sold. And technically, you don't have to get a loan. You could have other income. You could have other cash that you bring in, but somehow you got to get back up to the $1 million.
Wow.
But again, that's full deferment. If you are willing to understand that you're going to get partial taxation, you can do a partial exchange. You can take money out of the deal. You can buy a lower priced property, as long as you're understanding that all of that you took out is taxable. So it's effectively just splitting the deal. We're going to recognize some of it is the taxable gain, and to the extent that we bought a new property and put money back in, then we're going to get deferment on that. So it's not an all or none proposition, even though you do hear that a lot.
So whenever you say that it has to be a like-kind asset, does that mean that if I'm selling a 3-bedroom, 2-bathroom rental home, I have to then buy a 3-bedroom, 2-bathroom rental home?
Absolutely not. That is one of the biggest misconceptions, and it's understandable. The term like kind is in the law. Like kind for real estate means any real estate that is investment property. So a commercial warehouse is like kind to a single family. A multifamily apartment like you all deal in is like kind to retail centers. Even raw land can be held for investment. Ag leases, hunting leases, things that we have a lot here of in Texas. Even oil and mineral interest are exchangeable as a real property interest. So effectively, the like kind, that term used to have more meaning years ago with the law, because there were other things that could be exchanged besides real property. There used to be some provisions in the law that allowed you to exchange certain items of personal property. And then like kind had more of a distinction of real estate is not like kind to personal property. They cut that stuff out of the law back in 2017. So really, like kind doesn't carry as much meaning within the law as it used to.
Good answer. Yeah, that's
good to know.
That's actually more expansive than I even thought. Now, another question. So someone says, "Oh, well, I can just do a 1031 myself. I can just Google it, fill out the paperwork from the IRS." Why do we need a qualified intermediary for this process?
Okay, so using a qualified intermediary, the IRS has said that qualifies you for a safe harbor. And a safe harbor is basically a checkbox that would, if you got audited for saying that you did a 1031 and you tell them that you used a qualified intermediary, then you're going to get I won't say a free pass, because you're still getting audited at that point, but you're going to get a lot of deference that you used an outside third party to handle the money and administer the rules. You cannot do it yourself, because the moment you get control of the money, you can't do an exchange. That's sort of one of the primary rules, and really what a QI is mostly for is to be the middleman to hold the money, to say, I never had control of it. When I sold this property, I never got the value in my hands, because if I did, it was taxable. So I worked through this third party. They sort of administered the IRS rules and helped me go through it. Like when you do a deal with me, the first document that I have you sign is an exchange agreement. That is just a contract between somebody selling a property and my company, but everything that's written in it mimics the IRS guidelines. So really, the seller is agreeing to be contractually bound by the IRS guidelines, and I'm agreeing to contractually hold to those guidelines. That's how I hold the money, when I'm allowed to give it back to them, what it can be spent on. The timeline, of course, is the strict timeline on how long it can go. That's all what we agree to up front. So that's what you get by using a QI. In a strict sense, the IRS does not require a QI or somebody that's in the business of being a QI, but you cannot have the money held directly by your realtor, by your accountant, by your attorney. There's a bunch of disqualified people. So once you take all those people off the table, who are you going to trust to do this? Well, somebody that's in the business of doing it.
Yeah, that's awesome. So say someone is thinking about selling their investment property, thinks they're going to net well into the 6 figures. At what point would they involve a QI?
In a strict sense, we need to be involved before they close. I mean, and it can literally even be the day of closing. I happen to office here with the title company, and they do get this call at the last minute where somebody wants to do an exchange. So we can step in and do documents fairly quickly at that point and make sure they get signed correctly and the money gets routed to the right place. In a better sense, we get involved in a typical deal. We'll get involved when the contract is signed, because that's when we have ironclad information. We know for sure that something is getting sold. We know the price. We know the title company. We know approximately when it's supposed to close. And shortly after a contract is signed, we usually get our title commitment with legal descriptions. That's the information I need on my document. So that's when I can actually get active on doing something. Now, from a strategic sense, prior to selling, I have lots of conversations with people that want to talk it out before they even put their property on the market. Or maybe they're actually looking at what they want to buy. They've already got their eye on their replacement property and they're sort of working it backwards, and they want to ask questions about more complex things like reverse exchanges. There can also be some scenarios well in advance of sale if you own a property maybe in an LLC or with a few other people, and you're really looking to split from that group and go on with yourself. If it's in an LLC, that's something that we might be able to recommend. Well, the LLC currently owns the property, so the LLC would be the one entitled to do an exchange. But if you guys go ahead and maybe dissolve your LLC, distribute the property out to the individual owners as tenants in common, we do that ahead of you selling it. We're setting the stage ownership-wise for each of those parties to then go on and do an exchange. A lot of times that comes up last minute because people didn't realize till they went to sell that could be an issue. So I would recommend strategically maybe talking about that well in advance of selling.
And once you sell the property that you plan on, organizing a 1031 exchange for, how long do you have before finding a replacement property?
Okay, so the primary timeline you need to be concerned with is 180 days, and that is from the start of the exchange to the end. The start of the exchange is the day you close on your sale of your property, what they call the relinquished property. So actually closing day is day 0, and the next day starts counting 180. We have to have a closing on all of your replacement property, whether that be one or more, within that 180 days. It's a strict deadline. I can't adjust it. It's part of the information that goes on the tax filing. There are sometimes extensions based on natural disasters. Sometimes the government will give some extensions, like if businesses are shut down, like Texas had the big snow ice storm a few years ago. We got some extensions on it for that, hurricanes, those kind of things. But as a general rule, there's nothing I can do about it. Within that 180 days, there's an internal 45-day deadline to identify your list of replacement properties. And I view this as sort of the IRS saying, okay, we really want you to do this quickly. We want you to kind of narrow down where you're going within 45 days, write those properties down on a list, and give it to your QI. And it has to be signed. That's an important part of the identification. They don't really care about the contracts. I mean, you can do identifications when you don't really have anything under contract, or you can have it under contract. The IRS actually doesn't really look at the contract side of it. But if you do on day 45, whatever's on that list, it locks in. And so if something's on the list, we now have an exchange that will stay active either till it runs out on day 180 or you buy all the properties. If you have nothing on your list, what I call the bailout decision is you can put nothing on the list and your exchange will be over on day 46 because there's no eligible property to be purchased. And that does happen. We get people that, they're selling. They're not sure if they're going to be able to find a property, particularly in the prior years when it was such a seller's market. It was hard for buyers to find something sometimes. So a lot of them would start an exchange if they weren't satisfied with what they were finding, or maybe they couldn't get a contract locked in. They would just not identify anything and they'd take their money back, and no harm, no foul. They no longer could claim they were doing an exchange, but they didn't really lose anything other than the processing fee that we charge up front.
Okay, Oh, how much is that processing fee? One. And then another question I have is how long is the process? So we have a really amazing ER syndication going on. Say somebody wants to jump in on that deal, but they haven't even started the process of a 1031 exchange. How
Mhm.
much time do they have? How long does that process take?
Well, everything prior to them selling is, that's a little bit of a variable on how long it's going to take them to sell their property and actually get to a closing. The true exchange for me starts when there's funding, when something's sold and we receive funds. You know, I talk to people that might have properties listed. I know that once they get contracts and closings that we'll be doing exchanges, but that's just market conditions on how long it takes to get something sold. So there's no, I guess, other than me processing that paperwork, which I can do very quickly, there's no real set time period. That's just market conditions on when they can get it sold. So if they want to invest, say, in one of your projects, but they've got a house that they want to get sold, they're just going to have to kind of figure out real estate market wise if they can get that sold in time to meet your deadlines for your investment.
So the timeline is more dependent on the real estate being bought and sold versus any clerical stuff with the IRS or your company, correct?
Correct. There's nothing really set up in advance with the IRS. That's kind of an interesting thing. Even the service that I provide between the sale and the purchase, that isn't really the exchange itself. The exchange comes when you file your taxes and you say, I sold this and I bought this. Everything that we're doing is just setting up that you followed the procedure to be able to make that filing.
Got it.
So it is actually possible that somebody could do everything with me that I would call an exchange, but if they go on their taxes and decide, never mind, I'd rather just pay the taxes now, for whatever reason they might want to do that, they could file it normally, and really what we did didn't matter because they filed their taxes and didn't claim the exchange at the time they filed their taxes.
Wow.
Okay.
Yeah, that's so good to know. Okay, also, is there like a certain net profit that a investor expects to make that it would make financial sense to do a 1031 exchange? Like, does it make sense if you're only going to net 30K, or would you say into the six figures is really when you should start thinking about that? Just based on like processing fees to engage a QI or the IRS or anything.
The fees are, I think, relatively low. And you asked that question earlier. We break our fee into two parts. One is the sale of the relinquished property, which happens first. So we charge $1,200. And that really is the initial file setup and getting it all going. We send our invoices straight to the title company. We're coordinating with them so people don't directly come out of pocket to pay us. It comes out of sale proceeds. And then when they purchase, we charge another $300 per closing on the purchase. So if they sell one and buy one, it's a total of $1,500. I think that fee is fairly reasonably standard.
Very
there might be some
reasonable, yeah.
national companies that are doing it for a little bit less than that based on volume. But the industry standard is that it's a flat fee. It's sort of because it really doesn't matter how big the deal is. To me, it's the same paperwork either way. There are different fees for more complex reverse exchanges and improvement exchanges. Those are more custom price, running $5,000 to $10,000. So going back to your initial question, is there a certain deal size that this makes sense? I guess at the very bottom level, yeah. If you're concerned about the $1,200 and you're making what would be a $20,000 or $30,000 profit, yeah, it may not make sense at that point. But what I would really say is to understand the value of it, of whether it's worthwhile, is have your accountant or a qualified tax person give you an analysis of what your taxable gain would be on the sale of the property. And that's going to be looking at your upside, your appreciation that's going to get capital gains tax. It's also going to be looking at how long you've owned the property, how much depreciation you've taken, because depreciation recapture, of course, is a component in there too. A lot of people forget about that one. They just look at, I've made X amount of dollars. But depreciation will, if you've had a property a long time, will definitely add up. So whatever that number comes back to be, that is the value of what you can reinvest. If that comes back that you might only have a $5, $10, $20,000 tax burden, it might be better just to pass and go on and pay your taxes, and then you won't be under this timeline. You can reinvest your money at your own schedule. But if it's a more substantial number and you know that you are going to buy replacement property, why not get that benefit with it?
And is there any paperwork that whoever is going through that 1031 exchange, what kind of paperwork do they need to give you? Do they need to be prepared with some type of documentation to start the process?
For my purposes, it's actually fairly straightforward. When I fully engage with a customer, a client, I'll send them that exchange agreement that I already mentioned. That it's a contract. We DocuSign it. I have a few little informational papers I send them as well, but that's the first thing that kicks off the deal. After that, I start talking to their escrow officer about the closing, and I really have two documents that get signed in the closing package that I will send to the title company, and it's an assignment and a notice of assignment. And kind of the legal structural part of an exchange, what allows me to step into it is that they assign part of their sales contract to the QI. That's why the money is routed to us and why we sign the settlement statement. And so those two documents go, and they're very straightforward, kind of one page each. And the notice document is for, in the case of selling, it'll be a buyer's notice to tell them that an exchange is being done on this transaction. Nobody has any problems with that. They'll just sign off on it. And then the same thing in reverse when we're now later buying the replacement property. It's kind of a reverse of that assignment. They're assigning to me the obligation to purchase the property for them up to the value of the money that I'm holding for them. And then they have to put in any overage above that or any loans or anything. So paperwork wise, our exchange is very simple: an upfront contract, 2 documents when you sell, 2 documents when you buy. There's a few other peripheral documents in there, invoices, wire instructions, some other things that go back and forth with the title company. But signatures wise, it's really 3 documents. Now, talking with an accountant or somebody doing that analysis that I mentioned earlier, that would require more in-depth look back at their taxes. Like, how have you reported this? What do your tax returns look like during the time that you've owned this property? How much depreciation? So that's more of an accounting question. And that's one thing I do want to say, that QIs are not the accountants in the scenario. We talk in hypotheticals about tax burdens and things, but we don't do analysis of any particular person's taxes for them. That's something that they have to do on their own and then go forward with us.
Okay, and so then how does a person go through the 1031 and actually invest from a single family investment into a syndication?
Okay, so with syndications, what you all are doing are bringing together investors into a limited partnership. So those investors are not directly buying real estate; they're investing in a company. Kind of like buying stock, but it's a partnership and not a corporation. But functionally, it feels like they're investing. That limited partnership is actually going to go buy some real property. So if somebody started where they had their own property, they started an exchange by selling it, they need to finish the exchange by buying real property. So investing in a syndication directly is not the path that they can take, because that won't qualify. But they can, if the syndicator is willing, work with them in what they call a tenants in common arrangement. That is where they effectively come in and they buy a share of the property directly. So the syndicator might be the bulk of the deal, might have 90% ownership of that property that's being purchased, and maybe there's one or two or a few other players that came in and they had what we would call exchange funds. So they came in and they took up that other 10% of the deal, subject, of course, to some agreements with the syndicator that they were going to be kind of silent partners in that scenario. You're going to put your money in, you might directly own 3, 4, 5% of this property, but it's going to be controlled by the syndicator, and all of that is going to stay in place. So it's going to function just like you made the investment like the LP investors did, but you were directly on title, which is what you needed to get the checkbox for a 1031. Those folks can also later, when the property is sold, they can continue on and go. That can be the start of a new exchange for them, because once again, they are selling property, and they can go from there with another exchange.
That's awesome information. Thank you so much. And I will say, Andrea and I do allow 1031 exchanges dependent on the property, but we do have a minimum of about $500K because there are some clerical things we need to do in order to set up that tenants in common. So is there, this will be our last question, but are there any like big mistakes that you see made in the 1031 exchange process and you just want to warn people about?
I think the biggest mistakes are just thinking that the rules aren't going to get applied, like that the timelines can be bent, or that the identification periods are that we can identify after the 45 days, those kind of things. We're also not understanding the implications that starting an exchange does tie your money up. There are only two ways to get your funds back once you're in an exchange. At day 46, if you don't identify anything, you can get all your funds back. Or at day 180, if you ultimately decided not to buy anything, you will get your money back. But in between those, depending on certain facts and what you've done, your money can be held up. So that's the thing that I think is maybe the most counterintuitive to people, is that they think that they can bail out of it at any time they want and just get everything back and change their mind. And that's, unfortunately, the way the IRS rules work. That's exactly what we're agreeing to contractually that we won't do. We won't bend these rules, and that's why we are a QI and why the IRS gives us the deference of using a QI, is that you're being held to that standard. So I think that's probably the thing that I caution inexperienced people on the most, is understanding what this means for their money and when they can get access to it.
Got it. No, that's really helpful to know.
Yeah.
It's once you start the process, you got to commit.
Yeah.
Thank you so much, Jason.
If we have a listener that's interested in exploring the 1031 exchange process, how is best to get in touch with you? And do you work outside of Texas, or are you solely focused on acquisitions and purchases inside Texas?
Now, we can work anywhere. That's the great thing about this business for us, is because we were talking about federal IRS. We can work for purchases and sales anywhere in the United States. A few of the states have some different regulations, but for the most part, 45 of the states are all the same. We are located in Austin, so we tend to have connection with customers that are somehow related to Texas. But I've done transactions, I think I kind of keep account of almost 20 different states now. People selling in other states, moving to Texas, some people moving out of Texas. Every once in a while, somebody moves out of Texas.
They're rare.
Yeah, very rare. But no, we can work anywhere. And the best way to get a hold of me, we actually literally just this morning launched our new version of our website. We are under 1031 Texas, but we changed our domain to 1031texas.com. So domain-wise, actually the old one, ten31texas.com, is still active and will redirect. So you can get a hold of us there. You can set up a call. And I think a lot like you guys do, I'm always on the phone with people about potential deals and explaining all these little nuances of what works, what doesn't. Is this a viable exchange for you? And happy to do that. And we do quite a bit of presentations too. We got to the brokers and the attorneys and the title companies and kind of educate everybody on it, and then to be that resource.
That's fantastic.
Great.
Thank you so much, Jason. We're going to include all of Jason's contact info below, the website, all that good stuff. So if you guys are interested and want to know more, just check out the description and you can get in touch with 1031 Texas there. Thank you again for joining us, Jason. It was a pleasure.
Thank you, Jason. I'm so much smarter now.
Well, thank you for having me. I enjoyed it.
All right, Andrea, another episode in the books, and quite an information-packed one at that.
Oh, that's a good one. This needs to be shared just across so many platforms.
Send it to your friends.
Make it viral.
Yeah,
please.
let's go viral. We just want to make, like, you know, confusing and intimidating legal stuff and commercial real estate stuff really accessible, understandable, break down the barriers, you know, make it, like, easy to understand.
Easy
like,
to understand,
just
yes.
easy. I'm just sick of, like, everyone complicating everything. It's easy, guys. It's just a state of mind. Change the mindset, you know?
Yeah.
So definitely share this with people that you think might benefit from a QI, especially if you're looking to sell your investment properties, right?
Right. Yeah. This just unlocks so much knowledge. This episode has a lot of gems in it. And bring this to, like, your next party. Like, talk about a 1031 exchange. Sound knowledgeable.
You could be that guy at the party. I don't know that I'm going to bring up 1031 exchanges at my next party, but if the conversation does lead that way, you can sound super informed and knowledgeable. Because listen, we've dealt with 1031 exchanges. We thought we knew them intimately. Blew my mind. Like, stuff I had no idea about. I was like, oh my gosh, I can't believe, like the like kind. I had no idea that like kind was that of a loosey-goosey term. I thought it literally meant, I mean, listen, the example I gave, 3-bedroom, 2-bathroom home to 3, I knew that wasn't the case. I knew you could do, like, from a home to, like, a multifamily building, but I didn't know you could do, like, land to, like, a commercial industrial build. I thought, like, land was totally different.
Right.
But that's so cool.
Yeah, absolutely.
Genius.
I always thought that you had to go up, like, single family, and then it had to be something bigger. But that was not, like, kind either. So anyways, I'm glad y'all listened. Hopefully you got informed just like we did. Make this go viral, and we just love our listeners. If you have any questions, just reach out to us, email us. Definitely get onto our email sequence, which is more education, and then show us some love, please. Give us 100 stars and 100 reviews of how awesome.
And if you are exploring a 1031 exchange in the future, we might know of a place to put it.
Right.
We just might, so get in touch. All right, guys. Well, until next time, don't invest good.
Invest twice as good.
Bye.